Now, let's also talk about how the merchandiser and the manufacturer's income statements differ. Okay, the merchandiser makes sales of a product, so their revenue account is going to be sales revenue. Sales revenue, I'll abbreviate, well, no, I'll go ahead and spell that out. Sales revenue. And the merchandiser has as their major expense of doing business cost of goods sold. So cost of goods sold is subtracted before any other expenses because it's their major expense, so it's subtracted out up front. So sales revenue less cost of goods sold yields gross profit. Okay, and then of course less selling and administrative expenses yields income before taxes, or operating income before taxes. Okay. Now, how does the manufacturer's income statement differ? Well, frankly, this part is the same. The manufacturer sells a product either to other manufacturers or to a wholesaler or to the final customer. So just like the merchandiser, the manufacturer is going to have sales revenue. And just like the just like the merchandiser, the manufacturer is going to have cost of goods sold, which is subtracted from sales revenue to yield gross profit or gross margin. And the manufacturer also has period costs, selling and administrative expenses, which are subtracted from gross profit in arriving at operating income before taxes. So on the surface of this statement, of just the income statement, the two different types of businesses appear to have the same basic format. But the difference is in the calculation of cost of goods sold. In calculating cost of goods sold, which I'm going to abbreviate CGS, cost of goods sold, the merchandiser takes beginning merchandise inventory adds purchases of merchandise inventory and subtracts ending merchandise inventory in arriving at cost of goods sold. As I get to the bottom of the statement, my writing is much less neat. Okay, so merchandise inventory. But remember, a manufacturer doesn't have merchandise inventory. The manufacturer makes the product. The merchandiser buys a complete product and then just sells it to the final customer. So instead of having merchandise inventory in the calculation of cost of goods sold, this number up here, the manufacturer is going to use finished goods inventory. So cost of goods sold for the manufacturer is going to start out, again, beginning inventory, but beginning finished goods inventory. Finished goods beginning inventory, and instead of having purchases, remember the manufacturer manufactures products. So their equivalent to purchases from the merchandiser's income statement is the cost that came out of work in process, which we called cost of goods manufactured. So they will add to finished goods beginning inventory the cost of goods manufactured, which I'll just abbreviate MFR, cost of goods manufactured. So that account, cost of goods manufactured, or that amount, that subtotal, is the equivalent of the merchandiser's purchases in the calculation of cost of goods sold. And then, like the merchandiser, the final step is to subtract out the ending inventory, only it's ending finished goods inventory. And that then yields cost of goods sold for the manufacturer. So, income statement, basic form, looks the same. Sales revenue minus cost of goods sold equals gross profit, minus selling and administrative expenses equals operating income before taxes. And the cost of goods sold calculation is essentially the same. Beginning inventory plus what was added to inventory minus ending inventory equals cost of goods sold. The difference is in the inventory account title. A merchandiser, merchandise inventory. A manufacturer, finished goods inventory. What was added to finished goods inventory during the period is cost of the goods manufactured, the goods we made during the period. For a merchandiser, they had to buy their goods, so purchases of inventory. So different, same basic calculation, same basic relationship, but different terminology. So far so good.